Hello everyone, welcome back to the channel. So we have a lot of different things to cover today. I'll be covering the software company selling off, financial services company selling off, Amazon's earnings, Google's earnings, as well as Microsoft as a stock. So I'll be covering the software companies first. So your software companies have been selling off due to fears over AI, following Anthropic's new plugin, as well as terminal risk associated with the company. So my take is that all these software companies, they were previously extremely highly priced. So they're all trading at a premium relative to the markets, and it's only natural for them to revert back to the mean. The common thread right now that we're facing with all these different software companies are these three different points here. First one is lowered switching costs, second one is seat dilution, third of all is competition. I won't be touching on competition, it's a very common risk in the entire software as a service industry as a whole. I'll be touching on lowered switching costs first. So on switching costs, a lot of them have perceived high switching costs. What that means is that a lot of investors will label them as companies with high switching costs due to their ability to prevent customers from switching away due to high data migration cost. But if you've looked at all these different software companies, in particular Salesforce, there's actually lowered switching costs currently. So for example, Salesforce no longer has as high of a switching cost as compared to previously. So they now allow their clients to access data outside of Salesforce, meaning to say if they don't want to use Salesforce anymore next year, they can simply switch over to another CRM because the data is stored externally. This is called your zero copy. So the other argument here is the argument of seat dilution. So in the case of all your different software companies, if AI is able to do the same amount of work in a shorter period of time, or if AI is able to handle a lot of the task, what this means is that the human subscription, the number of humans actually subscribe to the software service, will actually decline over time because there's less need for it. So your software companies are fundamentally changing their business model. So this is currently spearheaded by companies like Microsoft, Salesforce, like Adobe as well. And with Satya mentioning previously, he mentioned this months ago, that he is trying to change Microsoft from a traditionally software-driven company to one that is more solutions-driven. So I agree with Satya, and this is why I'm bullish on Microsoft as well. As for the other software names, those that are focused on just workflows as well as processes, my opinion is that they'll be impacted the most. So currently now in the software space, you have three companies, Microsoft, Salesforce, Adobe, Intuit to a certain extent as well, that's pivoting their business model away from the traditional subscription business model. And they're currently adopting a token-based or solution-based business model. I believe the winners will be the ones that will adopt this model the best, while protecting the traditional business model, the traditional subscription business model. And in this case, I think the answer is quite self-explanatory, the one with the larger scale, which is Microsoft. The transition period, however, will likely be a volatile one because they are switching from a high margin, recurring subscription business model to one that is more consumption driven, that is lower in terms of predictability. But as long as the company is able to protect their core business, I think they will do fine. In the case of Microsoft, I think it has the scale to weather the storm. I'm not too sure about the others. Next part, I'll be moving on to your financial services companies. So a lot of your financial services companies, namely the credit rating agencies like your FICO, S&P Global, as well as Moody's, they've been selling off because of AI. So the key argument here is that market participants, they currently think that AI is able to create a score, can process data quickly, they can look at reports very quickly and come up with a summary, and they can probably predict a score better than the traditional S&P Global, Moody's, or your FICO scores. So while this is relevant and it might affect the credit rating agencies, I think this is nothing new. We already have an existence of this in the form of Upstart, for example, in terms of consumer credit rating. And despite this, your credit rating companies like S&P Global, Moody's as well as FICO have dominant market shares in their individual segments. And the reasoning behind of this is simple. They are the infrastructure, they are the language to their respective industries. So over here, this is what Dev Kantesaria actually said in terms of the ability for AI to disrupt FICO as well as S&P Global and Moody's. So he said over here that two kids in MIT, if they come up with a score with a better mathematical model, they don't displace FICO because in both instances, the ratings are cheap relative to the overall issuance of debt. It's cheap relative to the credit decisions that banks have to make, whether it's 50,000 loans or $1 million mortgage. And the stamps of approval for a bank that wants to follow the evolution of its credit quality and its loan portfolio over time, or a bank buying another bank, or a bank wanting to securitize their debt. This is the only way for them to make sure that people trust the credit ratings as well as the credit portfolio. So in the case of FICO, FICO is the industry standard in order for your auto lenders, your banks, your lenders, your mortgage lenders to track for consumer credit health, to securitize their debt, and in order to sell their company. When there's already an industry standard in place, it is unlikely for them to be displeased. And second of all is that FICO has a strong moat in the mortgage industry because it is regulated by your FHFA. So FHFA only allows FICO scores as well as Vantage scores to be used when companies are trying to securitize their debt and sell it to your government-sponsored enterprises. In the case of S&P Global as well as Moody's, it's the same thing, it's regulated. So they are part of the 10 nationally recognized statistical rating organizations regulated and approved by the SEC, meaning to say that even if AI comes up, there's no way to switch from S&P Global as well as Moody's. So S&P and Moody's ratings, as Dev mentioned, allows enterprises to fetch a lower interest rate due to higher levels of trust that has been built over time. Time and reputation is something that cannot be easily displaced. So the traditional business models are, in my opinion, minimally subjected to AI risk. I think the AI can create scores and incorporate data, but it all boils down to a few different things here, a few different concepts. Trust, friction, and time. So friction can be reduced in terms of AI if the AI can do it faster. But for all the businesses that are successful in the entire world, it is all driven by trust. For example, Visa. Visa is successful because your issuers, they trust Visa's ability to handle their clients when it comes to transactions. Same thing, your merchants, they trust Visa. Same thing for Costco as well. People go to Costco because they trust that Costco can provide them with the lowest price. So one of the most important things for a business to continue operating well is trust. And there's no doubt that in your credit market, in your consumer credit market, and your corporate debt market, S&P Global as well as FICO, they are trusted. So they're selling the trust. As for the software businesses, S&P Global is currently the one that is at highest risk because they spent a lot of money buying IHS Markit with the market intelligence and the commodity insights as well. So 36% of the company's EBIT is currently tied to software, which is the recurring streams. Moody's is closer to 30%, FICO is closer to around 20%. So AI advancements will probably weaken pricing power and may cause seat dilution in these segments, though the market seems to already be pricing in the impact before it actually comes, despite the embedded nature with the traditional ratings as well as the scores. Next part, I'll be covering Amazon's earnings. So on Amazon's earnings, my quick summary is this, my TLDR is this. Amazon's numbers were not bad. AWS accelerated to 24%. Their revenue also grew at double digit, and the numbers that the markets were fearful about was primarily the CapEx number. So they're projecting around $200 billion of CapEx in 2026 this year, which was significantly higher than the market estimate of around $150 billion. So and the strong signs that the management has said that this CapEx will not slow down is fearing the markets, along with the optimism by Andy Jassy. So he said over here in these two transcript reports, he said, we expect to double it again in 27. We added 1.2 gigawatts of power in Q4, and we're expecting a lot more in 2026, in 2027, and in 2028. So he's hinting that the CapEx is not going to slow down. Besides that, he also said that, I'll start with the first one, backlog grew at 40%. I think it's up 22% quarter on quarter. You know, we have a lot of deals that are in the pipeline. There's just, as I mentioned, a lot of demand for AWS right now. So he is extremely bullish on AWS. Throughout the entire transcript, he was just highlighting how AWS can grow a lot more. AWS is supply constrained and he's coming off as a bit too overconfident. So he claims that AWS demand is unlike anything we have seen, and this supply constrained nature of AWS will continue for the next few years. This was what he said throughout the entire earnings call. So my summary for Amazon is this: I'm neutral on the firm, although I would have preferred a more level-headed commentary of the earnings. Not extremely bullish, neither am I bearish on the stock. Next one, Google's earnings and some hidden bear takes. So Google's earnings were amazing. So the company showed strong monetization of AI with operating income growing mid to high teens and revenue acceleration as well. And GCP grew at 48%. YouTube revenue was the only bad news, so they saw some form of a deceleration to around 9%, though I would attribute that towards a shift to their subscription business model. And the management also said that this is because of the cyclical nature of the advertising business, because you had a very strong year in 2024 for YouTube. So there's one key takeaway that I would like to highlight in Google's earnings, reading between the lines. So this was actually a question that was posed by Mark Mahaney. He's the Evercore ISI correspondent. So he said over here that you talked earlier about Jim and I being the AI engine for some of the most successful software companies out there. And it just seems there's a market belief that these software companies are kind of losing seat power, losing pricing power. It looks like it'll be really terrible for this customer base here. So this was Sundar's response. He said, look, at least from my vantage point, I definitely see we're very, very good SaaS companies who are leaders in their respective categories. And what I see the successful companies doing is they are definitely incorporating Gemini deeply in critical workflows, be it on improving their product experiences and driving growth or driving efficiencies. So Sundar Pichai is sort of dodged the first question, so he spoke about the second one. He didn't really speak about the software as a service situation and the companies currently. What I feel Sundar is subtly hinting but not overtly saying is that your software companies getting hit might hurt Google's entire business. So it's a flow. Your GCP, they serve your software clients. If AI disrupts your software clients, then what happens is that GCP will get hurt as well. This is natural. Another way for you to interpret this as well is that he's saying that Gemini will be sort of like protecting the entire business model by being so deeply embedded that the customers of the software companies will still need Gemini even if those software companies go bust. So, and this brings me to another linking point that I would like to highlight. So Satya mentioned previously that in order to prevent AI from becoming a big massive bubble, the efficiencies have to expand outside of just tech. So in industries like healthcare, in all sorts of industries, efficiencies need to flow to those segments as well. So same thing here, in order for these cloud companies to continue preventing themselves from getting hurt with this domino effect, if your software companies start falling, the only way is for them to expand outside of tech. So what I'm presenting here is sort of like a bear thesis for your cloud companies as well. It's just the opposite case. If your software companies get hurt by AI, then obviously companies like Google, like Amazon, like Microsoft, your three hyperscalers, will eventually get hurt as well because they have a lot of clients from these software companies. So they need to diversify out of this, and we have to see if they're able to do so, if there's any commentary on it. Last part is on why I'm bullish on Microsoft. So Microsoft's current business is currently under supposed threat, and selling off despite great earnings. So I saw this sell-side report as well. This is from Stifel. So they downgraded Microsoft to a hold. And what they said over here, quite interesting, is that they said it is near-term cautious, while long-term AI positioning is strong. So what they're saying is that the short-term outlook is weak, but the long-term outlook is strong. It's a bit contradictory, and it's not really long-term thinking. So for Microsoft Business, I think they're less prone to seat dilution. The company has the ability to increase pricing power. That's the first one. So they can make up for the seat dilution with their ability to increase prices. And we've seen very strong pricing power over the past few years. In fact, this year, they're planning to increase the prices as well. Second of all, the company has the ability to bundle everything into a suite of products. So for example, what they're doing right now is they're bundling Copilot into some sort of a bundle instead of providing it as an optional purchase. So what this will help Microsoft do is it will help it to justify the price increases. And second of all, it helps to increase the stickiness as well. So in the case of Microsoft 365, I think the stickiness with enterprises will likely remain strong because it's an industry standard. You learn Microsoft stuff in school. You learn Microsoft stuff in university. So on the agent front, Microsoft launched Agent 365. Agent 365 is a security layer for your agents that you deploy, and it is agent agnostic, meaning to say that you can use external agents as well for this. So there is also an option for Microsoft to bundle this to their existing business products. This is the power of Microsoft. So in my opinion, Microsoft has the scale and wants to become the platform for agents. And what this means in the future is that all your other companies, they will have to take the risk, while Microsoft just serves as some sort of a platform. So with a combination of strong backlog numbers, offering predictable earnings, excluding the OpenAI segment, if you're bearish on OpenAI, Second of all is the strong pricing power. I think Microsoft is a safe bet given the depressed valuations of the firm. I hope you guys have found this video useful, and I'll see you guys again.